Welcome and thanks everyone for joining us this afternoon for the part 2 of our Wealth at Your Fingertips webinar series. I'm Jennifer Nai, Executive Director of Tricor Hong Kong, and I am the moderator today. Last time in part 1, regulators have shared their insight on the recent development and government's initiative in promoting Hong Kong as a wealth management hub for family offices and other investors. We at Tricor are very excited about the latest development as we provide our client support from the incorporation and administration of funds to the setting up of family trusts. If you have missed part 1, please feel free to access our replay. A link to it should be included in your webinar invitation. Today in part 2, we will have a few industry professionals to dive deeper into why Hong Kong remains a natural choice for the high net worth investors to look for investment opportunities. Now, let me introduce to you our guest speakers today. On the other side, we have Ray Lam, Managing Director and Co-founder of Raffles Family's Office, joining us this afternoon. Ray has extensive experience in banking and management. He has over 15 years of experience holding various positions in international financial institutions. At Raffles, Ray is responsible for corporate governance, staff development, and strategic growth of the company. Today, he will talk about why Hong Kong is a preferred jurisdiction of choice for family offices to set up. Following will be Mr. Mark Unick, partner of Mayer Brown resident in Hong Kong. Mark is specialized in a variety of transactional matters for asset managers, family offices, and other investors groups. He has extensive experience in private equity, venture capital investments, including the formation of private equity infrastructures. He will share with us Hong Kong's advantage under the new limited partnership fund regime and the attractions of Hong Kong as an asset management hub. So finally, Tricor's Global Head of Tax, my fellow colleague, Mr. Chi Wang Lee, will talk about the tax benefit of setting up family offices in Hong Kong. Chi Wang has over 35 years of tax and business advisory experience. He has very deep knowledge and understanding of the tax considerations throughout the entire life cycle of companies in various industry and family offices. Chi Wang is a CPA in Hong Kong, in Australia, and also in Malaysia. So welcome, gentlemen. Towards the end of the webinar, we will conclude with Q&A sections. So if you have any questions to our speakers, please send us your questions anytime, and we will gather them and address them in the Q&A sections. So now, let's begin with Ray. As one of the world's financial center, Hong Kong has always been a top destination for family offices in Asia. Raffles has a global exposure. So can you please share with us your experience of dealing with family office from different regions, and also what are their main concerns when choosing where to set up a family office? Ray?
Thank you, Jennifer. So I just have to share screen, right? Yeah. Let me share my screen.
Oh, hey, Ray.
Yeah.
Have you turned on your camera as well?
Oh, sure.
Yeah, thanks. Okay, so we see you now.
Yeah, it's okay?
Yeah.
Right, perfect. Get a full screen. So, can anyone see that clearly? Right, that's great. Okay, thank you. Thank you, Jennifer. Thank you, Tricor, to setting up the session for everyone. And this is a bit of introduction for myself. This is Ray Tam. I'm the co-founder and managing partner of Raffles Family Office. So maybe a bit of background of what Raffles do. We are actually the multi-family office in Asia, providing one-stop wealth solution to the global investor. We have offices in Hong Kong, Singapore, Taipei, and Shanghai right now. So the 4 major cities that we are located in. So before I start this topic that maybe like not everyone of you knows that Raffles may sound very Singapore to you guys, but Hong Kong is actually the still the headquarters and as well as the first location that we choose when we start off the family office here. And me myself is I was born in Hong Kong and I was brought up in Hong Kong for my childhood before I moved abroad to UK. So I mean we are very Hong Kong based family office as well. So I'm going to give a very short and clear pictures what we think of why Hong Kong is a good place for setting up family office, as well as the like Jennifer mentioned, like the concern, also the consideration for all the family office, why are they choosing here? So I think the first impression for Hong Kong is always a global leading source of alpha that we're looking at. You can see from the capital market that we are having in Hong Kong right now, it's still the most active fundraising place or even IPO place in the world. According to 2019, the total fundings that has been raised in Hong Kong market is actually over $40 billion US. And last year, everyone may know that it's a pandemic year, it's a very hard year. Hong Kong still doing a very good job, a strong performance. We actually bringing up over 11 jumbo IPO in Hong Kong, which means that one IPO is actually bringing over $1 billion US per company. That's including JD.com and NetEase. So I think that's a very key point here is that there's still very strong attraction for investor, as well as, I mean, because of that, there's also the PE, the private equity sectors that is very still attractive here. If you see there's lots of opportunity of listing, also like the opportunity here that the PE, actually like the PE fund, which is very focused on the Asian market, they're very trying to use Hong Kong as a headquarter in their fund as well. So among the top 10 private equity fund house that are actually running in Asia, 5 of them is actually having headquarters in Hong Kong. So I think this is something that we attract the investment point or the alpha that we mentioned about for the global investor. And so why is there such a big market here? I think this is something that is quite relevant, that as we're having a very mature infrastructure, also the ecosystem with the professional talent pool. When we talk about this, I think, I mean, here's some very interesting figures that I may show you guys that according to the professional reports from CPA and also SFC, Hong Kong MA, for the asset manager, wealth managers, the registered professional, they're over 45,000. The banking professional over 100,000. Audited accountant and chartered accountant in Hong Kong is 45,000. The registered professional in insurance sectors, 121,000. And the legal services provider, which is the lawyer and barrister, has over 13,000 in Hong Kong. So basically, there are 200,000 professional providing services to what the family office needs to run their own family's management in Hong Kong. So I think this is a very key point here, is why we can still attract lots of Asia or mainland-based China family office to set up the Hong Kong as in their headquarters, also a deal sourcing place, as well as for the Western and the international family office together here to exchange their information, also their ability to share with each other. So if we looking into some deep dive to the regional outlook, obviously, in the past 20 years, I mean, family office is an idea, or is a term that has been spreading from the United States through Europe, then to the Asia. And obviously Hong Kong and I think Taiwan is having a huge number of growth in terms of the mature and sophisticated understanding in the idea of what family office is. So if you see from the figures from the UBS report in 2019, the figures that we see from the Asia Pacific itself, the newly set up newly established family office is having 39% overall, which is 4% above the average of the global growth on that. Obviously, it's outperformed from the Asia, from the Europe, and also from the North America. And also, if you see, if there's one family office that they have a wealth close to 1 billion, they're going to put about over 60% of their wealth to be managed under the family office, which is a very healthy number compared to Europe, North America, and also for the emerging market. So from that, I think the key here is Asia has always been seen as the world's fastest growth in high net worth individuals. Having said that even China alone is actually producing 4 in like 10 billionaires, like in every 10 billionaires they create in the world. So that's bring the key part that, I mean, Hong Kong is having still a big benefit from the increasing amount of Chinese high net worth clients looking to diversify their investment, always beyond renminbi assets as well. So there's a huge potential for the growth in population, also the economy that bring in from Asia, which means that, as mentioned, that the number of billionaires or even millionaires that they have their wealth to be taking control or taken care of. That's why I think family office is always a service or is an entity, is a platform that they should consider to set up in Hong Kong. So here, I think this is some sharing of what we think about the family office. Okay, I mean, the most common misconception about like the role of really what family office do. People may very focused on, okay, we are just like, having the wealth solution, very focusing on the investment strategy, right? But the actual family office is really to diverse the family office solution, included but not limited to, of course, like the family governance policy, estates, succession planning, as well as the philanthropy program here. That's and again, why we choose Hong Kong as the place that we set up the family office. As we mentioned, that for the whole process that we have to bring on from this purpose is always included or require the support from the external advisor, tax advisor, bank custodian, also the lawyers, as well as I think trustee like TriCo. So here is a very key point to work together, and we also having like the successful wealth management family office, which is the main goal of the real family offices, is for a long-term and multi-generational family legacy and successional planning. So for the wealth preservation, growth, and also transfer of these wealth, we always have to bear in mind that the deficiency of the wealth management, and also how do we engage all these professional parties is a very key point here. And that's here where we wanted to share more with you that how RFO, Raffles Family Office, that approach to really offer the solution to the client. So I would say that to split into a few different sectors. First of all, as we mentioned, rather than just investment, family governance is always something that we are very keen to look at. As you can see that for a real successful or family is very unique, and their needs and their family structure is very unique. So I think the firm family value is a key. It's actually a very standard or a foundation to be a successful wealth long-term legacy planning. So from here, I think a successful long-term legacy planning that we should include that we should set a very clear objective, also a management parameters that to manage your wealth. And also it has to be a very efficient or the efficient transfer the wealth through a different generation. So in Raffles, that the reason we have our own insurance brokerage license, that we provide like different insurance solution or wealth solution to all of the families in-house, and as well as how we work together with all the professional parties, as we mentioned, the trustee, the tax lawyer, and also the accountant. There's something that we have to put together in order to execute these family governance. And also, I think on top of that, the investment governance that we mentioned will be more focused on the selection or the expertise that we can bring on. So to allow the easier coordination and I think the consolidation of the wealth, this is why we have Hong Kong and Singapore as a key or hub for the Greater China market, also for the Southeast Asian market. Hong Kong, we're under SFC license of Type 409, and also in Singapore, we are MAS licensed and a capital market license. So this is where we can provide the solution for all these families that to manage their wealth in different jurisdictions, as well as I think to engage expertise from different platform or the wealth planning solution in the Asian market. For that, we are now having also, I mean, for later on in the webinar that maybe we have more sharing on the private equity side. But this is always something that we're helping our family, or especially for the global investors who are coming to Asia, and we want to share more about like how the Asian market works on the private equity deals as well as the club deals that we share between families. And this is something that I think for the investment governance part that is important for all those families to have a more structural and also professional teams that to be taken care of. And last, I think for the operational governance, it's more about the gatekeeper role that to help to control and also to lower the non-essential costs. For that, I mean, it's very typical for us to have open architecture so that the information or the families that they can do it in a one-stop shop within Raffles to provide the solution to them, as well as I think for the fund structure for those investment or asset class that we want to diversify into different mandates or even set up in order to match their the families maybe under trust the investment manager that they would like to segregate the fund. So for the operational governance, the other point here is we also provide the consolidation reporting standard for the families. So which means that whenever the asset class that included in the family, that we can provide a more clear and also a consolidated report for them to manage. So from all those points from here, I think from our point of view is to really set up a family office in Asia, in Hong Kong. It's actually allowed the opportunity for like the traditional market, such as in Europe or even in America. They would like to explore more on what we can do or how the Asia families has been going on, and as well as Hong Kong is still a very good opportunity as a window to the Greater Bay area of China, also as well as I think for the traditional transfer of the wealth and also asset to the next generation. How do we leverage on our experience from the more mature market that we can bring on to Asia? So here's what I want to share with all of you. And after that, we have a Q&A section that we might be able to share more. And then from any questions that we'd like to know or with contact, please feel free to let us know. Thank you.
Okay, thank you, Ray. So now let's turn to Mark. So Mark, Hong Kong has very unique attractions as an asset management hub in Asia. Can you tell us more about the Asian asset management landscape, and also how does the new Hong Kong Limited Partnership Fund regime compare to other jurisdictions such as the very popular one like Cayman Islands and Singapore?
Thank you, Jennifer. Can you hear me okay?
Yes.
Good afternoon, all. Here is the agenda for our session today. Before getting into the details of Hong Kong's new limited partnership regime, I wanted to set the stage a little with a quick review of the asset management landscape in Asia. We will then look at the limited partnership fund ordinance and a brief review of a comparison with a couple of other regimes. In recent years, there's been a shift in the Asian asset management landscape, which has seen mainland China emerge as a key driver for growth. We will see this in the statistics in the following slides. Although we do not have data from 2020 yet, I suspect that this trend has continued or perhaps accelerated. As you can see from this slide, China's contribution to total PE investments in the Asia Pacific region in 2019 was approximately 40%. Here you can see how China's contribution to capital under management dwarfs the other countries in the region, making up over 50% of the total and almost 70% if you combine it with Hong Kong. We can also see how Hong Kong itself has benefited from this growth with the increase in the number of private equity funds and venture capital funds registered here. The market evolves. There's been a marked increase of co-investment activities in Asia by private equity investors joining forces with each other and with other institutional investors, with venture capital funds, and also with local family offices and their networks. We just heard from Ray. The rise of the family office in Hong Kong and the more formal partnering of family offices through a multi-family office platform is also helping drive development of the asset management industry here in Hong Kong and in Asia generally. This trend has brought a related shift in some investment behavior, leading to, in part, more diversified and direct investments, an increase in investments in sectors such as technology and healthcare, and a focus on environmental, social, and governance, or ESG issues, and related sustainability and impact investments. Another factor is the impact of the Greater Bay Area on Hong Kong's asset management industry. Ray touched on this a bit, but as one of the most affluent regions in China, it has a combined GDP of almost US $1.6 trillion, greater than some G20 economies. It is noteworthy that 20% of China's high net worth families, those with assets in excess of RMB 10 million or more, reside here. Also, the launch of the Wealth Management Connect, the pilot scheme, should create more investment opportunities for asset managers in Hong Kong as the scheme matures over time and investment quotas and the number of products covered increase. We will now turn to Hong Kong's efforts to enhance its competitiveness as a hub for asset management activity through the new limited partnership fund regime. The limited partnership fund ordinance took effect on 31st October 2020. This new regime significantly improves the legal framework for setting up and operating private equity funds and other funds established as a foundation for eligible funds to be registered as limited partnerships here in Hong Kong. The old regime, partnership regime, which was enacted back in 1912, could not accommodate the needs of a modern private equity fund. This lack of flexibility adversely impacted the movement of capital, freedom to contract, operational matters for the fund, dissolution mechanics, and public disclosure. We now briefly review certain key features of the new regime. The following are the basic eligibility requirements. There must be one general partner and at least one limited partner. It must be constituted by a limited partnership agreement and have a registered office here in Hong Kong. Those are the basics. As to the GP, the ordinance requires that a GP be either a natural person of 18 years or older, Hong Kong company, a non-Hong Kong company, a limited partnership under the ordinance, or a non-Hong Kong limited partnership. With respect to the LPs, they can be any of a natural person, a corporation, a partnership, an unincorporated association, or any other entity. Now, the key governance requirements include the GP having unlimited liability and ultimate responsibility for the fund. This is true across most regimes in the world. The ordinance sets out the GP duties, including a requirement to appoint an investment manager, which may be the GP. We'll touch on that a little later. It's important to note that the LPs cannot have day-to-day management rights or control over the underlying assets held by the fund. The LP's liability will be limited to its capital commitment so long as it does not participate in the management of the fund. Importantly, the ordinance sets out a non-exhaustive list of safe harbor activities which are not to be regarded as taking part of the management of the fund for the LPs. We'll touch on this again later on. A few other features. There's no minimal capital requirement. Withdrawals and distributions of capital are permitted, subject to a solvency test. And a fund established under the ordinance does not have separate legal personality. While there's a process for limited partnerships that were set up under the old regime to move under the new regime, subject to certain eligibility requirements, the new regime does not cater for the migration to Hong Kong of funds established in other jurisdictions. We'll also talk about that in a second. There are some gaps. The 1 GP limitation limits structuring options. As you may know, in China, co-GP arrangements are quite popular. Having a 1 GP limitation does not allow for 2 GPs to manage the same fund or set up the same fund. This is not a critical restriction, as it can be structured around by having 2 shareholders in the 1 GP. The lack of separate legal personality does not make Hong Kong an outlier, but it does introduce some complications for holding assets and structuring options. The lack of a migration mechanic, though, may limit the draw of Hong Kong to sponsors currently with arrangements elsewhere. We'll come back to that. Although not part of the ordinance, the success of this effort will depend on the taxation regime in Hong Kong. The current tax concession for carried interest under consideration is a critical piece of this. We will now take a brief look at a couple of commonly used jurisdictions, namely the Cayman Islands and Singapore, to see how Hong Kong compares on some of the key features we just noted. The Hong Kong ordinance is broadly similar in many respects to the regimes in both the Cayman Islands and Singapore. Some distinctions exist, but these do not materially detract or disadvantage Hong Kong when compared to the other regimes, in my view. As you will see from this slide, where there's broad similarity in approach across the 3 jurisdictions on these core principles of governing law, general partner, legal personality, and the registered office and place of business requirements. Again, the treatment of these features here relating to movement of capital and freedom to contract are substantially similar across the regimes. As you can see here, there are a few differences in this feature, looking at the duties and responsibilities of the GP. One relates to the requirement to appoint an investment manager. Commentators pushed back on this aspect of the ordinance before it was adopted, and although this requirement was retained, the eligibility requirement for the investment manager were relaxed. For example, the investment manager may be the GP and may need not be an authorized institution. If the GP is a fund registered under the ordinance or a non-Hong Kong limited partnership without legal personality, the ordinance requires the GP to appoint an authorized representative who will share ultimate responsibility to manage the fund and be jointly and severally liable along with the GP. The ordinance also requires the GP to appoint a responsible person who will be responsible for conducting the anti-money laundering and counter-terrorist financing measures. The requirements on the GP in Hong Kong the custody requirements imposed on the GP in Hong Kong are handled slightly differently than the other jurisdictions. Generally speaking, however, the administrative duties and responsibilities of a GP in Hong Kong are more extensive than those in both Singapore and Cayman Islands. This is not critical, and I don't think it disadvantages Hong Kong to any great degree, but it's noteworthy. Again, broad similarity here. I want to make a note about the migration feature, though. While the regimes are currently comparable in this respect, we understand that there may be some movement in Singapore to create some flexibility for migration into Singapore. So this is something for Hong Kong to note. The onshore advantage. This has a couple components. As we talked about, there is a global offshore to onshore shift brought on by the efforts around the globe to combat tax avoidance, money laundering, and terrorist financing. This has created a regulatory risk, or at least a challenge for fund managers who have established their funds in offshore regimes without economic substance. In addition, we have seen LPs, particularly those that have development or social impact type mandates, refusing to accept these jurisdictions for their investment mandates. This is important. In addition, there can be operating and governance benefits and efficiencies for sponsors to combine or unify their asset management activities in one jurisdiction. These efficiencies include cost savings, compliance, and governance benefits, as well as operational and managerial efficiencies from centralizing structures in a location where a fund manager already has existing operations and substance. Some noteworthy trends that we talked about, looking back at the outset with the regional developments and the growth driven from China, these noteworthy trends show that Hong Kong's adoption of the new fund regime is timely and nicely coincides with the Asia Pacific region attracting an increasing share of the global equity assets under management. As noted earlier, the contribution of Greater China to the private equity and venture capital landscape in the region is significant and growing. The new ordinance represents one of a series of timely initiatives in Hong Kong, particularly relating to capturing mainland opportunities, both inbound and outbound. These initiatives include promotional support from both government and businesses in Hong Kong, including Invest Hong Kong and the newly formed Family Office Association. Of course, as mentioned earlier, the evolving tax landscape is key here. There are other market developments, such as the impact of technology on the industry and the rise of ESG and the importance of sustainable and responsible investing, which are becoming more and more important for GPs and LPs alike. Thank you all. I'll now turn it back to Jennifer to introduce our next speaker.
Thank you, Mark. So now let's move on to Tax Chi Wang. I know you are an expert in tax compliance and advisory. So what, from your viewpoint, are the tax benefit of setting up family offices in Hong Kong comparing to other jurisdictions? And what advices would you give to those who are planning to set up family offices in Asia?
Well, thanks, Mark and Ray and Jennifer for your insights. I think the key to tax is it's very fact and circumstance driven. And so whatever structure or planning we put in place has to be tailor-made for a particular client's needs. And why not just jump into why Hong Kong is a good platform to actually think about your residing in your family office and using Hong Kong companies or LPFs to actually use Hong Kong as the base. And basically we have a common law system in Hong Kong. It's a territorial basis of taxation. And what that means is, for those on the call who understand Hong Kong tax, I'm sure some of you do, is only Hong Kong source profits are taxable. Non-Hong Kong source profits are non-taxable. So we have an onshore offshore regime it's not etched in the law. If you look at Section 14, it doesn't say what is onshore, what is offshore. So it's very fact and circumstance driven. So if you have onshore profits, if you have business that is run in Hong Kong, your customers are here, all your sales and purchases are conducted in Hong Kong, that's onshore. But you have investment outside of Hong Kong. A typical example is interest, right? You have a deposit outside of Hong Kong, interest earned offshore is not taxable. But as Mark alluded earlier, under the BEPS regime, the OECD is looking at things like transfer pricing. And there's a comment in the OECD model to say you have to pay your fair share of tax. So we don't really know how long this onshore offshore regime will last, because ultimately at some point in time, and we can't tell when, the offshore regime may not be able to sustain that argument. And we have low tax rates in Hong Kong. It's a two-tier system, 8.25 or 16.5. And any accessible profits up to 2 million is taxed at 8.25. But you can only have one nominated entity in your group that qualifies for that lower tax rate. The beauty of Hong Kong is we have no VAT, we have no GST, we have no capital gains tax, and no estate tax, no inheritance tax. So it's a pretty nimble regime, no withholding taxes. And when it comes to capital gains, if you have an entity, say, buying or selling a property, we look at whether it's a capital or revenue gain. So, and you have to still look at holding period, how you fund the investments, do you make improvement to the property you acquire? So it's kind of a common law system. We look at case law to argue whether that gain is taxable or non-taxable. And pretty relatively simple and straightforward compliance requirements. You file your personal tax returns, you file your corporate tax returns. There's a query system. If the revenue is not happy with your return file, they come back and ask you questions. As long as you're able to substantiate with documents to say that you have basically, that transaction is kind of supported by documents. Transaction is arm's length. You will basically be able to satisfy those requirements. And we have close to 80 double tax treaties signed, up to about 40 are in force. And so when it comes to planning, it gives you flexibility in structuring investments outside of Hong Kong. And as some of you may know, we actually collaborate a lot with the Greater Bay Area. They have a superior talent scheme card. If you're a Hong Kong professional working in the Greater Bay Area, you can apply for the card and you get an IIT rebate on Chinese taxes suffered in China. And people ask, if I get a rebate in China, is it taxable in Hong Kong? The Hong Kong laws are not clear. So if we need any further advice on that, we're more than happy to help you. And this is a brief overview. I just covered some of that just now. So it's territorial basis. Income source in Hong Kong is taxed here. The slight difference in Singapore is income source in Singapore is taxable, plus income source in Singapore, if it's remitted into Singapore, is taxable. What does it mean? So if you are a Singapore company, you earn income in Singapore, it's taxable. If you derive income, say, from an investment in Indonesia, as long as it's not remitted back to Singapore, it's not taxed. Once it's remitted, it's taxable, right? So dividend interest source outside Hong Kong, Singapore, generally not taxable. Both countries don't tax capital gains. Our tax rates are pretty close to Singapore, but we do have a two-tier system. Singapore has more DTAs. I mentioned earlier, we have 80, but only 40 are in force. Theirs is about 90 are in force. And we have no indirect tax. And Singapore has a 7% GST. So that actually adds up when it comes to transaction costs. And I want to cover a little bit about how you get treaty protection in Hong Kong if you're making investments into China. The family offices that I come across typically make investments into China because that is one of the key focus markets. And if you are really investing into China, I always ask my clients, where do you want to base geographically? Where you can jump on a boat, a train, a car. We have so many flights to China pre-COVID. And so it's for accessibility and getting to know the market, the cultural similarities between Hong Kong and China, you have to be in Hong Kong. It makes a lot more sense. And if you are a Hong Kong company having an investment in China, I think Mark, you mentioned about substance. How do you get benefit of the Hong Kong-China Treaty? Now, if you're a Hong Kong entity with no substance, and we'll come to that what we mean by substance, any dividends paid out from China to the Hong Kong parent will be subject to 10% withholding. But if you have economic substance, where the Hong Kong entity has economic substance in Hong Kong, you have to apply for a tax resident certificate from the Hong Kong revenue. If you get the certificate, your withholding tax rate on that dividend is down to 5%. So it's substantial savings. And in the good old days, when I mentioned good old days, maybe back 5 years ago, it's so easy to get a tax resident certificate. Just show up with the IRD, produce your certificate of incorporation, produce your business registration certificate, and you can get a tax resident certificate. In the current climate, you can't. And you can't because China is saying, hang on, we don't just give out this 5% preferential rate. You, as a taxpayer, if you want to avail yourself to that advantage, show me a tax resident certificate issued by the Hong Kong IRD. And when the IRD receives your application, they look at a few things. The composition of your board of directors for the Hong Kong entity. And we would typically say the majority must, I wouldn't say would, has to be, I think must be Hong Kong residents, based here, working in Hong Kong. So if we have 4 directors, 3 out of 4 has to be Hong Kong residents. And the board must actually meet physically in Hong Kong. And I know in the COVID environment, that is challenging. And there are some ways to get around it. I won't cover that in the interest of time. And the other key is typically board meetings are held once a year. And some of my clients have ran into a problem where I only meet once a year to adopt the financial statements. That in itself is not good enough in the current environment. You must make sure the board meetings are held to discuss and make critical investment decisions that a company is going to get into, like investing into China, investing into Indonesia. Those must be well documented, right? On top of that, they look at the HoldCo. The HoldCo cannot be just a pure holding company holding an investment in China. It must have real people with a physical office in Hong Kong. Apart from holding the Chinese investment, you have to make sure that HoldCo has some other forms of businesses. Maybe it's a small trading company, it's probably managing some IP. And we actually help a lot of clients look at the current makeup and to make sure that we don't fall foul of the rules. So moving on, Hong Kong is a great place for investments in China using the Hong Kong-China Treaty. And typically people say, most family offices try to compare Hong Kong, Singapore. Why should I be in Hong Kong? Why should I be in Singapore? Now, Singapore has come up with many schemes, 13CA, 13R, 13X. And if you ask me, they offer incentives, yes. I won't walk through all of them. And so Singapore is competing with Hong Kong to attract family offices. And I have clients also setting up family offices in Hong Kong. They've also set up one in Singapore, right? And I asked them, why do you want to be in Singapore? And the key reason they say is, we are looking at investments in Southeast Asia. We want to be closer to the market. That's where the buzz is. And that's why typically most clients of mine who have moved, I wouldn't say moved, who have set up another family office will pick Singapore for that particular purpose. And these incentives are quite generous, but I would say one thing, Singapore incentives come with conditions attached. I call it the Singapore sting. And why do I call it a Singapore sting? For example, they say you must spend at least, your asset under management must be at least Singapore 50 million. Your minimum business spending must be at least 200 Singapore thousand a year. Now it's quite easy. You rent an office to hire people, and they need you to hire locals, right? And so they, the reason I call it is thing, if you don't meet those conditions, your incentives under those sections will be taken away. Moving on. I think, Mark, you covered about LPF, and I won't run through it in the interest of time because you mentioned, you hit the nail on the head. In terms of the tax concessions for carried interest, I think if the revenue can come with more definitive rules on how carried interest will be taxed, this unified funds exemption, I think this is really a starter, would become a more attractive concessionary schemes for people who have family offices in Hong Kong, and And the key again is substance. You mentioned you need a registered office. On top of that, that office has to have substance. Real people, real office, key decisions made here, right? Investments into countries that you want to take treaty advantage. You must make sure you have all those. Indonesia is another example. If you're paying a dividend out of Indonesia to Hong Kong, they also look for your tax resident certificate. So with that, I will stop here, Jennifer. I think there are questions coming through. I can see, and we were more than happy to take questions from the audience.
So thank you, Ray, Mark, and Chi Weng for bringing us your insight and perspective. I was actually trying to organize
I'm sorry.
Oh, sorry, I think we were muted. Okay, let me repeat. Okay, I've got questions from the audience. That's for, I think I addressed it to Mark. So Mark, there's one question. So would fund sponsor benefit from using a Hong Kong limited partnership structures in order to attract mainland Chinese LPs and Hong Kong institutional LPs, and even for an outbound non-China investment strategy?
Hi, thanks, Jennifer. Yeah, it's interesting. I think that the China-based GPs and funds with China's focused strategies have already expressed interest in using the Hong Kong LPF structure for sure. I think the proximity to China will be an important factor here in seeing that development. And also, it's interesting that the RMB fundraising market appears to have collapsed with a significant, I've read almost 90% drop from its peak. So that may further create the LPF structure here in Hong Kong as an attractive replacement for local RMB structures. It remains to be seen. But these GPs are likely to have substance and operations in Hong Kong because of the proximity. And so some of the things we just heard about, those requirements may be met. And the governance and other benefits that I mentioned and efficiencies in operation, should exist. So I think all of these things, I think are in the first instance are likely to drive certainly China-based GPs and China-focused funds to Hong Kong. Again, the tax structure is critical in all of this, but certainly I think they will benefit from it.
Okay, thanks, Mark. So I've got quite a few questions related to family offices. Ray, maybe you want to take this. So what are the challenges of setting up family office in Hong Kong, and how do we overcome? And if we see any opportunities for family office in the coming years?
Yeah, sure. I think the thing here is, I mean, we see a lot of inquiry, like, every years from different like global investors that they're seeking opportunity. Not just for like Southeast Asia family office, also from the mainland Chinese family office that they're seeking here, but as well as other from other jurisdiction. I think the key here is always about how do we gather the right people and the right team which has the onshore ability or the on-the-ground services that they can provide to them. So that will take up their time, their course, such things. So actually, I want to echo what Chi Weng just mentioned. I mean, why just Hong Kong or Singapore? So why not both? So I mean, the very key point here is to be a smart move that I think the two positions that we're looking at here. So that's why I mean for a setup for family office to take the real challenges is you have to be nimble, and at the same time that you appoint the right people to do that. So with Hong Kong, like what we mentioned, we have so many professional parties. We have tax lawyer, we have asset managers like Mark, like Shiwen, you guys from Trico. So why don't you just do something that is existing or is already like formed? So from here, I think like what from our point of view, like of course, like from Hong Kong government, there's support from Hong Kong, Invest Hong Kong, and also for the Family Office Association, that we are able to provide like more direct solution for the client, and as well as like family office like ourselves, that is we always open the gate or like the opportunity for everyone. So I think that to overcome these like all these difficulties, that the key will be like engage the right people, and also when you choose that jurisdiction, that is always matches what your investment and also your long-term planning is. I mean, from family office point of view, there's always something we plan for a long run. You're not looking at just 1 or 2 years or 3 years, even 5 years. You're looking like transgeneration planning. So that's why I think for diversification, for the people that you get into, it has to be experience, and then having the professional teams that can support you. So again, you mentioned the last bit. Of course, we see a great potential, as we mentioned, that the wealth or the accumulated wealth that's going up in the next 5 or even 10 years is going to be huge. And as both like Mark and Shiwen also mentioned about, it's always an opportunity that we tap into the mainland China market, as well as the good company that they have right now in their the whole economy. And also I think about it's about accessibility again here, that you have to have a setup in Hong Kong so that you have the direct access to what you have to do, and then the right people again.
Thanks, Ray. To carry on what Ray has just shared, I've actually got a question for Shiwen. I understand we always got clients asked about where to set up the family offices. So what are others, or are there more factors that would normally consider before they are picking up on a location to set up their family office?
I think, Jennifer, that's a great question. When my clients come and see me, we don't just talk about tax. They talk about, why should I pick Hong Kong vis-a-vis the other locations? And most family patriarchs, they ask that question. And the clients I see these days, and the clients I currently have on my portfolio, they'll ask questions like, do I need a trust? Why do I need to set up a trust? And as Ray mentioned earlier, there are a lot of IPOs, and most of these IPOs are China-based companies seeking a listing in Hong Kong. And once they are listed, multimillionaires, billionaires will become millionaires overnight. And typically I say, don't set up something after your company is listed. Think about pre-listing planning, be it a trust, be it a family office. And I say, think about the common law system, all right? And think about the country, the region you're familiar with. So sometimes the place they want to live, and the people they know, the people that come across, and the connections, the business network they have, that is also one of the key considerations. Tax, legal, to Ray's point, the professional pool, lawyers, accountants, that is kind of the synergy that this pool of people bring to the client. That's what they're looking for. They don't want to go to a place where everything is they're not familiar with. And a lot of them kind of look to their friends and say, if my friend's a family office in Hong Kong, they will ask the question, why am I not thinking about that? So what we are talking about, tax, legal, trust, they're all in the equation, but that commonality, that's kind of what their friends have and what their friends are doing also influences their decision. I don't know whether that makes sense.
Thanks, Shiwen.
No.
I think we can take on maybe one more questions from the audience. So Mark, so let's go back to the LPFO. So what would, or could the LPFO, the new ordinance, have it on the global fund managers with a long-standing institutional investor base, but have a significant China or Asia component to the strategy?
Yeah, as I indicated, I think that we're likely to see the China-based GPs here to be the first movers. I think it's a little less clear how we'll see international managers and global managers who have kind of tried and tested Cayman structures or Delaware structures, if they're out of the US, see them move. So I think there's one of the challenges that there's going to be some inertia for change for certain of these broader, more global structures. And we have to remember this regime is new, although it's based in very similar principles in other common law jurisdictions. It's untested. So I think it may take some time. That said, as I touched on, if there's a shift in investor preference, you've got LPs, new LPs driving you, or maybe a shift in target investments, or a drive from investors and others for greater efficiencies. I mean, I think these things may cause some more international managers to consider Hong Kong. I think one thing that's interesting, though, that particularly for the global managers, is as you may know, these large international funds often have parallel structures. They may have a Delaware limited partnership alongside a Cayman limited partnership, and we've not seen this yet, but I think there's an opportunity for the Hong Kong structure to be used as part of a global complex fund management structure, as a parallel or fund or a sub fund as part of that, for perhaps to attract regional investors that are more comfortable with the Hong Kong regime. So I think there's a lot of attributes here that could be tapped into, but I do think that it'll take a little longer to see that shift for the more global international managers than, say, for some that are more connected to China.
Okay, thanks, Mark. Time passes quickly, and it's about time to wrap up this webinar. I think from the three presentations today, we understand that Hong Kong has been and will remain one of the most ideal places for setting up and operating a family office. Considering the availability of and the ease to access investment opportunities, and from legal and tax perspective. So on top of the government's determination to promote Hong Kong as a wealth management hub for family offices and investors, we have a strategic geographical location, a strong talent pool, as well as some well-developed, efficient, world-class infrastructure to support different financial activities. So thank you all again for your participation. I hope you enjoyed the presentation and the discussions as much as I did. Here is the QR code for accessing a questionnaire, and it's most grateful if you could spare some time to complete it and share with us your feedback on today's sections. Meanwhile, stay tuned for Tricor's webinar series and look out for our next webinar invitation. We will continue to explore different topics and keep abreast of the global trend. So goodbye and see you next time.